New legislation has been proposed that could significantly change your required minimum distributions. Is it all good for you? In this video, I will share with you those changes to required minimum distributions, a change in the code for the IRS with regards to penalties, new inflation indexes, and one of the biggest mistakes many retirees make. But before we get there, subscribe to my channel. I have over 30 years in this business, and I want to share with you some of the pitfalls that I see many make who are transitioning into retirement. One of the biggest components of planning retirement is the required minimum distribution, because planning for this particular event has an impact on so many areas and so many items that you must think about for this next chapter of life. First, when should you start taking money out of your IRA? There are some out there who believe that you should delay it as long as possible. Others, depending upon your certain circumstances, think that it's better to take it off before required minimum distributions. When should you take your Social Security? Should you delay it? Should you coordinate it with those very distributions from your IRA? And how do you think about your cash flow need in the various stages of retirement so that you can have what you need as you pursue your goals? And the cash flow need begs the very question of, where do you get your income from? And more importantly, how do you reduce the impact of taxes, which again leads us back to the required minimum distribution? And that brings us to the big one, which is actually managing the whole process of the required minimum distribution, where many retirees make a big mistake here that could be very costly. The answer for you really relies upon the planning. Everyone's circumstance is different. I certainly don't have enough information to share with you what my advice would be for you particularly. But it is in the planning that you will find the answers to these questions. So let's review this proposed legislation and how it could potentially impact you. So first, what is a required minimum distribution, or what we'll say the RMD? So when you reach a certain age, and up until a couple of years ago, that certain age was 70 and a half. But during the pandemic and the Secure Act, that 70 and a half was moved to 72. And now in this proposed legislation, it could go all the way up to 75 before you are forced to take out a minimum out of your retirement assets. Now, the reasoning behind this from the government's perspective is you've been allowed to have this money grow tax deferred all this time for many years. And they want you to transfer it basically from the tax deferred account and take it out so they can get their fair share of taxes, because the money coming out of your retirement plans will be taxed in most circumstances. Now, in that very first year of distribution, you'll need to take out approximately 3.5% of your overall assets within your retirement pool. And this is where I think you need to be very careful here. And I have a tip for you here. And it's what I share with my clients and recommend it to them. I think it's important here to try to, as much as possible, consolidate as many of your retirement plans as you can. Because here's the deal. The IRS says, let's say you have $1 million in 5 different IRAs. They're saying at a 3.5% number approximately that you'll need to take out $35,000 from the $1 million from your pool of IRAs. They don't care if it comes from one of them, two of them, all of them. just as long as you take it out. But here's the problem. And the custodians that you have your IRAs with, each and every one of them must by law send you a notice telling you what the required minimum distribution is from each respective account. So it can get very confusing when you see 5 different letters come in with 5 different numbers, and you may get a little overwhelmed in terms of, well, what should you do? So the best tip I can give you here is, where possible, consolidate as much as possible into 1, 2, or 3, however many you can, so that the titling is the same, so you eliminate some of the excess paperwork so you can manage the distributions better. By the way, this particular tip, this is probably our biggest role with our clients, to make sure they don't take out the wrong amount or don't take out any, because there's a huge penalty. And I believe it's the biggest mistake many retirees make as they reach that age of required minimum distribution. So let's take a look at what the legislation is doing in terms of moving the RMD up to age 75. So for those who are born between 1951 and 1956, your RMD is now moved from age 72 to age 73. For those who were born in 1957 and 1958, that RMD is moved to age 74. And those who were born in 1959 or after, your RMD is now 75. Now, my guess is that for most people, that's good news, because they really didn't need to or wish to take the money out of their retirement plans, because when it does come out, it is taxed. So you'll need to go back to your advisor to find out how you can manage this new table, assuming it does become law. The second change in the proposed legislation is that they're going to be reducing the very hefty penalties for not taking out the proper amount for your required minimum distribution. So up until now, it's been a 50% penalty for not taking out the minimum. Now, you could take out the whole thing. You could take out as much as you want, but you must take out at least the minimum. And up until now, and let's go through some numbers, let's assume that you were supposed to take out $20,000 per the table, and you only took out $10,000. So you were short $10,000. The IRS says it's a 50% penalty on the amount you didn't take out. So that mistake would cost you $5,000. Under the new law, they reduce that penalty by half. It's now just going to be a 25% penalty. So how can you avoid this penalty altogether? You may want to consider converting one or more of your IRAs to a Roth IRA, and you can take a look at this video to learn more about the Roth. But the big reason to do the Roth is that you take control of when you'll get the distributions, and you'll also eliminate any taxes. So the more you have in the Roth, the less you have to worry about required minimum distributions. You'll have more control over when you wish to take the income out, and there'll be no taxes and therefore no penalties associated with any money coming out of the Roth IRA. Now, the real question is, are you really prepared for retirement? In my latest book, we actually created a quiz for you. The book's title was Don't Outlive Your Money in Retirement, and the quiz is all about trying to figure out which stage of the retirement preparedness you are in. So if you go up to my banner, click on the quiz. It's a 15-question quiz. Immediately we'll get back to you a score to tell you which of the 3 retirement stages you are in, I'll get you a free chapter of the book and a couple of worksheets so you'll have some clarity about what it is you need to do. The third item is indexing for inflation. Let me take you to my screen for a second because this deals with what we call the catch-up provision. So if you participate in a retirement plan offered by your organization, a 403b, 401k, 457 plan, you have the ability, once you hit the age of 50, to add additional contributions. Right now, you can add upwards of an extra $6,500. And from the age of 62 through 64, you now have the ability to have an additional catch-up, and you can add an extra $10,000 for those couple of years. The final item is the qualified charitable distribution. This is an above-line deduction and very powerful. You must be 70 and a half or older. The maximum amount for the contribution is $100,000, and that is per person. And it must go to a charitable organization. So the important thing to remember here is, and even if you just have a little bit or you have a lot, that this money can come out of your retirement plan if it goes directly to the charitable organization. It will not show up as income for you, which will be a tremendous benefit if you are taking Medicare, because that income will not show up against your IRMA, so your premiums may not go up as a result of this. So keep this in mind when you are doing your planning. Now, all of this may seem like great news, but I will tell you, and this comes from one of the noted retirement experts in our area, Ed Slott. He said, depending upon your circumstance, this may actually not be good news. He was referencing specifically, since you are deferring your retirement distribution, and theoretically your assets in your retirement plans will be increasing, it means that when you take the money out at that point in time, you'll have more money coming out, and potentially at a higher tax rate. So the real key here is to go back to your advisor, do the planning so that you make sure you get what you need when you need, and don't fall into the trap of getting hit with the penalty if you don't take the right amount out.